Welcome to Getting Down to Business. This is our 10th episode. We've been through
Wow.
10 episodes, so that's pretty cool.
Look
Congratulations.
at us go.
Yeah.
Welcome to Getting Down to Business. In this episode, we examine an article that explains how practices are valued. We're going to be doing a deep dive into what makes a practice high value and how we calculate the true profit of a dental practice. We'll also be looking at factors that determine the capitalization rate, or ROI, for the buyer. Be sure to check out our book, Getting Down to Business by Norton Hinley. You can click on the link in the description and secure your copy. Don't forget to like this video and follow our channel for more great content all about running a successful dental practice. All right, now let's get down to business ourselves and start the episode.
Now, Eric had sent over an article, and basically the topic was unraveling the mystery of practice appraisals. And it was geared more towards veterinarian practices, but I wanted to bring it more into the focus of dental practices. Let's see what we can learn from this article. And I'm going to throw up some slides as well so we can kind of dissect those. But the first thing I want to talk about is practice value. Most people might think that the value of a practice is based on its gross revenue, which this article suggests that that's not actually true. The truth is that practice value is not a function of gross revenue, and that rather we can break practice value into two main components, which create the value of the practice. The first one being profit, and the second one being risk and or desirability. So let me ask you guys, when you do your valuation, what is the main goal that you're trying to arrive at?
Well, the purpose of evaluation is to determine the fair market value.
Ding, ding, ding.
Bam! Just like that. That's all there is to it.
And what is fair market
Yay!
value? Can you define what the definition of fair market value is for the audience again?
Sure. Fair market value is the monetary value at which a property would change hands from a willing buyer and a willing seller, neither of which are under any compulsion to buy or sell. And it basically establishes what is the value of that property on an open market.
You nailed it. We're trying to arrive at fair market value. So how do we determine, fair market value?
Well, at Henley Bergmeyer Group, we use multiple valuation methods. Not all methods will be appropriate for the business being valued. So we may review different method options and then either, agree or disagree that that would be the appropriate method or one of the appropriate methods to use. We use asset approach, income approach, and market approach. The value can come from asset value, meaning, we could determine that the best value for the business is the value of its tangible assets. That's why we talked about in a previous episode having the seller itemizing all of their tangible assets, because that is what we would consider the lowest end of the scale, of
Right.
value. It's going to be the value of their tangible assets. And then we also use market approach and income approach, where we value the business based on a multiple of what the market tells us, businesses in that specific industry are selling for, or based on that business's individual, ability to generate profit. There is a valuation method where, it is a price to revenue, which is just a multiple of the business's revenue generated each year. However, we consider that valuation method to be a rule of thumb, meaning that we may use it in conjunction with multiple other valuation methods to help, justify or support the value that we've calculated otherwise. But it's typically not the method that you would use to calculate 100% of the value, because it's simply a multiple of the business's revenue and does not look at the business's ability to generate profit.
The answer to this question of how practice value is determined is basically they're saying the basis of value is profit, and all high value practices have high profits, but not all high profit practices have high value. And so what we talked about, as far as, tangible and intangible, the tangible stuff, it's just that, it's stuff. And people don't necessarily want to buy a practice because of the stuff in it. They're looking at the intangible elements, such as the location, the quality of staff, the facilities and the services offered, etc. That's all part of the intangible elements that will add value to that practice. But the beginning point, according to this article, is to start with profit. And the true profit of a business is, taking those tax-based accounting documents and converting them basically into management ones. So after, basically the true profit is what's left after we subtract unnecessary expenses, one-time expenses, adjusting spousal and owner salaries either up or down to their fair market level. And then true profit is what's left over after subtracting from gross revenue all of the normal operating costs, which do not include the owner's compensation or rent. Those are not part of the profit. So the remaining amount, this is where we're going to get into something called the capitalization rate. And I'm really curious because I don't know that I've ever heard you guys talk about the capitalization rate. And it's a little bit confusing to me. So the remaining amount, the profit, is then capitalized. And
Correct.
capitalization of profit is the amount the average investor expects to receive on an investment every year, annually, with the investment being the value of the practice. Go ahead, Rachel.
It's the rate at which an investor would expect to get a return on their investment.
Right. Now, one thing I wasn't clear on, kind of confused about, like, why, if the capitalization rate is higher, it's considered like lower value. Because in my mind, I guess it's more like more risk, more reward. But it's like if it has a lower capitalization rate, say like 18% versus 35%, the 18% is, unless I misunderstood the article, it seemed to be suggesting that like an 18% capitalization rate is actually higher value than a 35% capitalization rate. And I'm assuming that has something to do with like the whole risk reward.
I just did a simple little calculation where I said if a company's profit is $1 million, that's crazy, but it doesn't matter. I was just looking for a round number. And the capitalization rate was really high, say 35%.
Right.
That capitalization rate is going to give me $2.8 million in value. Whereas if the capitalization rate is lower, if I have $1 million and I divide by 10%, I now have $10 million value. So go ahead, Kelly.
So Rachel, well, I just kind of looked this up just to give like a really like very simple explanation.
Mhm.
And they give you like an explanation on like a lemonade stand. It says, imagine you have a lemonade stand and the cap rate tells you how much investors will pay for your lemonade stand based on how much profit it makes. So here's how it works. Calculate the profit. First, you figure out how much money your lemonade stand makes after paying all the expenses like Josh was talking about before, like lemon, sugar, cups, and wages. This profit is what you're left with at the end of the day. Determine the cap rate. The cap rate is a percentage that investors expect as a return on their investment. It's like the interest rate you might get from a bank if you put your money in a savings account. Calculate the value. To find out how much your lemonade stand is worth, you divide the profit by the cap rate. If the investor, DSO, has a 25% cap rate, you have to divide that profit by the 25%. And that's what they see when they look at these dental practices. So everybody not everybody, but there's a lot of people that want like DSOs to look at their practice. There's certain guidelines, and this is part of that, like what they want or what they will accept. And it says here, For example, if your lemonade stand makes $10,000 in profit per year and the cap rate is 10%, you divide 10,000 by 10, which is 10% as a decimal point 10, and then you'd get $100,000. So based on the example, your lemonade stand would be valued at $100,000.
Mhm.
You'd be opening up one of those.
Right. And an investor or someone who's interested in purchasing, they may have like a threshold capitalization rate where if it doesn't meet this threshold, then I'm not interested in it because they want to know that my return on my investment is at least 25% or is at least whatever is the percent. So in that case, you're solving for the different variable.
Yeah,
Right.
and it's
Instead of us saying what it is, they're solving to say, okay, well, does it meet our cap rate requirement?
right. It says in simpler terms, the cap rate helps potential buyers understand how much they should pay for your business based on the profit it generates. So it's not, and that's why we look at years. We don't just look
Yeah.
at 1 year.
I was going to get to that when you guys do, or when Rachel, you look at your weighted averages.
Yes.
We're gonna get into that a little bit. So let's see if you guys agree with this. So how is dental practice profit figured? So according to this article, it says profit is not the bottom line number on the tax return that shows net income. Tax returns don't typically reflect true profit, so adjustments are usually required. Okay, so an owner should be paid the salary as the producing doctor. Second, salary as a manager. 3, rental income if he or she owns the facility. And finally, what is left over is the profit. And it is the profit that is used as the basis of practice value. Let's assume a gross revenue of $1 million. The owner produces 450,000. Production salary is 22% of personal production. The business is valued at 1.5 million. Fair rent for the area is 8% of building value. Management compensation is 3% of gross. The owner takes home a total of 325,000. So how much is the profit based on that formula? So now actually I think I can show this particular.
I think the production salary needs to be higher, but
Okay.
Well, and I don't know about, this article is about, the veterinary industry. I don't know about what, and we would call that return to labor. Um, we also employ all these ideas that you're reading off. The owner does need to be paid a fair wage, or we need to represent in our valuation that the owner is paid a fair wage for the job that they do. That
a
means if they
reasonable
are
salary.
not only seeing patients, as a professional, then they get paid at the fair market rate of any other non-owner professional. And if they're also the office manager, that we understand that when that owner sells the business, they're going to have to hire an office manager. So we represent that that expense does exist. Also, a lot of our business owners do own their property. That being said, the article says that they need to pay themselves rent. That makes it sound like they don't or might not pay themselves rent at all. I don't see very many people who own the business not pay a rent expense at all. I mean, it does happen, but less frequently. But what we need to do is represent a fair market value rent expense. So we'll reach out to, as we had on another episode, someone like Connie at Carr, who will help us determine what the fair market value rent is, so that when we represent ongoing expenses of the business, we are showing that they're paying fair market value rent just as if the next owner would pay rent. So all of those are required operating expenses. So we make sure that in our calculation of profit, we are representing all of those required ongoing operating expenses.
And you're trying to get to the true profit of the business, right?
Correct. And
Okay.
there are, when you mentioned that the tax return bottom line is not the true profit of the business, There are lots of perks to being a business owner, right? You
Sure.
get to run lots of expenses through your business.
Show me the money.
You may have expenses that are run through your business that are not necessarily required for ongoing operation. In that case, we would pull those out as discretionary expenses to represent the true profit of the business, where the next owner could use their discretion, but representing the true profitability of the business.
So like Rachel, I have a question. So for like discretionary expenses regarding when you talk about, that are required to run the business, I mean, a lot of times the staff needs to have CE.
Mhm.
Like, so that's a requirement, I think, right? To run the
Continuing
business,
education?
or is it not a requirement? And especially if the doc decides to take everyone to Vegas for their CE.
So in that case, it is going to be it's one of those it depends situations, because in something like the dental industry, yeah, a continuing education is required, but if the current owner, the selling doc, provides continuing education to his staff as a benefit, then we consider that an ongoing expense, because we are going to suggest that the next owner not change any of the benefits. So if all of your staff are currently receiving continuing education like reimbursements, or you're taking them somewhere to do their continuing education, we're going to continue to represent that as an ongoing expense. Whereas if the doctor themselves chooses to do their continuing education at Disney World each year over the summer with their family, that is discretionary.
I want to just kind of go on to the next portion here. So we've established that, true profit is
And
the
that
number.
management pay at 3% thing, no, it doesn't. I've never seen, oh, we pay our managers 3% of it. No,
I thought that
they
seemed a
get
little
like
low as well.
$75,000 or something like that. It's not like we don't calculate pay to a manager at a certain percentage. We calculate it as we know that in this industry, typically an office manager is paid in this salary range. Typically, but not at a certain percentage of revenue. No, we don't do it like that.
Yeah,
But this is not my
if
industry.
this is
But the
like,
idea is the same.
right.
We do want to set aside salary for the doc. We do want to set aside fair market value rent. We do want to set aside the expense to hire another manager if that's going to be required. So the idea is the same.
If practice A is the opposite of declining, if it's ascending, if it's trending upward,
Improving.
yes, thank you.
It's growing.
It might be a good idea, depending on where that doc is at, to start, hopefully, planning their exit strategy.
So this shows 3 years, right? And so we usually do 5. And if we looked at the 2 years before this, and 2020 probably wouldn't be that great, but if we were pretend like it was a different things happen differently in 2020. If we were to see like practice B, you would see a very clear picture that beforehand, if practice B was 60, 80, 100, and then it went 80, 60, like they should have thought about selling in 2021 when it was
Mhm.
increasing.
Yeah.
And then practice A is great that they're thinking at 2023 to sell at that point because they're improving and growing. Sometimes we get people that are in this practice B situation and
And
they
we
want a
want
lot
to
of money for their practice.
And we want to see growth every year. We want to see at least a 3% growth, to keep up with inflation every year. And every practice is going to reach capacity at some point, whether it's we can't see any more patients, our calendar is totally full, or we don't have space for another doctor, or there's ideas or ways that they could, generate additional revenue. But every practice is going to plateau at some point, and that's fine. You just want to, if you can, you would like to exit while you're at the plateau, and not before and not, once it starts declining. Once you say, man, I'd like to sell in the next 3 years. I'm so tired of working 4 days a week. I'm going to go ahead and back off a little bit and work 3 days a week. Well, you're free to do that, but understand that if the revenue drops off and you're less profitable after you already begin that decline, that your value is going to represent that.
Well, and also, Rachel, isn't this true too? That sometimes we have dentists that don't like, they're not, going to 3 days a week after working 4 or stuff like that. What they're doing, they're working the same, they're doing the same stuff. But what ends up happening is their employees, of course, because of cost of living and inflation and all of that kind of stuff, they have to pay them more. So now they're giving them raises, right? So now their salaries are going up past the threshold of what we like to see for the percentage of wages, right?
Mhm.
So now they're paying their people more. They're bringing in the same. They're paying their people more, and now they're like, "Oh, my profitability is kind of lower, so now I'm gonna spend more on marketing." So now their marketing amounts are getting higher. So they're basically closing the gap on their profitability by keeping things the same. If you have to pay your staff more, you probably should produce more.
Mhm.
Right.
That kind
When
of
was the
stuff.
last time you raised your fees?
Right,
Yeah,
exactly.
reimbursement rates, cost of goods sold. What am I paying for lab costs and materials and such? Like,
And even
yeah.
renegotiate your merchant services fees. I mean, a lot of people don't do
Mhm.
that.
This is where it gets a little bit confusing for me because to me, when I see something about a capitalization rate being high, I mean, that to me suggests, I mean, if the rate of return is the capitalization rate, don't I want a higher rate of return?
Yes, but that doesn't mean you're going to get it.
When I read the article, this like slowed me down a little bit too. But we're not multiplying by the capitalization rate, we're dividing by the capitalization rate. So I don't get 35% of $1 million.
Right.
So the higher the capitalization rate, the lower the value is.
Cool. All
I
right.
know it's like backwards from how your mind thinks because you think,
Think higher's better.
yeah,
Yes.
but we're
Okay.
not multiplying, we're dividing.
This is why you need to work with a professional because they're going to be able to understand these variables. So this article is pointing out that things like practice growth contributes an intangible value, as does geographical location. Tangible asset value is the value of the equipment in the inventory. However, it's income that buyers want, not stuff.
The equipment is not what's generating the profit.
Exactly. But then we talked about, the staff, long-term loyal skilled employees add value, as does a reasonable transition period by the selling doctor. And then I thought this was interesting. A multi-doctor practice where the associates remain post-sale will have more value than a solo DVM practice where the selling doctor leaves on the day of the sale. A small high-touch boutique practice has more loyal clientele than does a high-volume, low-cost practice. Now, I've never heard of a mobile dental practice, so I don't know if that would apply here.
That would be the one at the hotel room in Singapore.
Here's a good question. So, what about competition? Is does the if a practice is for sale in an area and there are competitors nearby, does that typically lower or raise the value of the practice? Does that factor in at all? Is it more advantageous to be in a market with several other practices or a few?
No, I mean, the more competition means that your clients have an opportunity to seek services from multiple other people. Obviously, if you had the market cornered on whatever is the service you're providing, then your value is going to be higher because you can't lose.
Right. They're choosing you. Okay.
Yeah, I have a practice right now that's like it's like in the middle of a residential area, and that practice really doesn't have a lot of competition at all. So that's kind of like a great example of, something that maybe less risk, right?
Mhm.
Rachel?
Yeah,
Because
less
they don't-
competition.
Yeah, less competition, less risk.
I mean, that's the purpose of a DSO, right? They're buying up all the competition.
I was curious about this section of the article, if DSOs are sort of considered corporate sales. So, it says we've been discussing fair market value and capitalization rates, but how do corporate offers compare to this? Corporate consolidators do not value practices on fair market value, but use investment value instead.
They really do a calculation of EBITDA, which Rachel,
Which we do
that.
also. We have methods that include calculating a business's EBITDA, and then we apply a multiple to that. The multiple is given to us by we have references that we use that tell us what is the market multiple for the specific industry and size of the business that we're valuing. And it just depends on what those factors, the industry and the size of the business, and that multiple can be 2.5 times EBITDA or 4.5 times EBITDA, or it can vary pretty significantly, especially in the size of the business. If you think of a business that generates under $1 million versus a business that generates over $5 million, the risk is significantly less the larger the business gets, because at that point they may have multiple locations. Now their risk is spread among different locations. And also, in order to grow that size, you have, proven processes and procedures, and you probably didn't get to $5 million in 6 months. They may have management teams that manage more than one location. They may get better rates on insurances. They may get better rates on materials and things. There are certain benefits that come with being a much larger business. And DSOs, when they buy you up, they can afford to pay you more money for your business because their expenses are not going to look the same.
So the conclusion here is just that practice valuation, much like veterinary medicine, is a science and an art. It's crucial to have your valuation performed by a qualified valuator who has experience in the veterinary field, or that's why it's important to, on the same line of thought there, to work with valuators who have experience in the dental field, which is where we have our experience. So look for a certified valuation analyst and ensure they specialize in dental practice valuations. So yeah, it's an interesting article. Obviously, it is geared towards the veterinary niche, but there's a lot that applies here as far as what your processes are in valuing a dental practice.
Yeah.
So yeah, I think it was an interesting article, maybe a little bit more complicated because we have to kind of separate the two industries a little bit.
And we can totally do valuations on veterinarian practices as well.
Totally.
That's a good point. Okay.
Absolutely. We are our most common client are, dentists, because we have Bergmeyer and Associates, where a lot of our accounting clients are dentists. So naturally they come to us for their practice valuations. But we can value businesses in lots of other industries and have.
Awesome.
And I love learning something new.
We also can facilitate sales in a lot of different industries as well. So
sales that include property.
Yes.
Thank you for tuning in to Getting Down to Business. We hope you learned something new, and we would love to hear from you. Send us an email with your thoughts on any topics that you'd like to hear us cover on the show. Visit our website, www.hindleybergmeyergroup.com, and send us a message. We'll see you next time.